Gold will be the backbone of the monetary system. Silver is critical to build a digital ecosystem. If silver moves up very quickly, as it has been, $2, $3, $4, $5, you're going to get a margin call like that. And they're going to say, you owe us millions of dollars. We need it right now. Higher the price goes, the more demand, because people start to freak out. They took for granted that it was always there and always available. And because the West suppressed it, was always cheap.
And then you go 4 digits and single digit gold silver ratio. We expect this to occur around about 27 on the gold silver ratio, friends. 27 gold silver ratio. We have a downside target of gold down there. Gold will be around 9K, we expect, and silver will be around 333. That's right. And you will have a 27 gold silver ratio. And if you go single digits on that, it's likely gold will go 10, 12, who knows? And single digits means 1,200 silver if you're 12,000 gold.
In this explosive market breakdown, precious metals experts Andy Schectman and francishunt outline a future monetary reset where gold and silver play radically different but equally critical roles. The discussion begins with the assertion that gold will form the backbone of the next global monetary system, while silver becomes indispensable for building and sustaining the digital and industrial ecosystem powering modern economies. As silver prices begin to rise rapidly, moving $2, $3, $4, or even $5 at a time, they warn that massive margin calls will cascade through the financial system, forcing leveraged players to deliver millions in cash immediately. As prices surge, demand does not fall. It accelerates. Investors and institutions panic as they realize silver was never as abundant or accessible as they assumed, especially after decades of Western price suppression kept it artificially cheap. The conversation then turns to a dramatic repricing scenario, a 4-digit silver price and a collapse in the gold-silver ratio toward 27. Under this model, gold targets near $9,000 while silver approaches $333, with even more extreme outcomes possible if the ratio moves into single digits. This scenario suggests silver could ultimately reach $1,200. If gold advances toward $12,000, marking a historic shift in global wealth valuation. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
So it's an asset that tracks the price, or it's an ETF that tracks the price of silver, and not even that great at that, but it is the largest silver trust in the world, and it would be far easier for JP Morgan to close that account, pay everyone their fair share of what their account was worth at the end of business on Friday, and say to the world, all we did is what the prospectus allows us to do. Now you're sitting on a huge stockpile of silver without breaking any laws or infringing any civil liberties. And, it gets interesting when we talk about JP Morgan, by the way. The Economic Times just came out with a report saying that they hold over 750 million ounces of physical silver, and that's worth more than $40 billion. And it would be the largest stockpile on the planet if that were the truth. The report is very interesting. It says they didn't just stop shorting silver, they actually flipped and became the biggest long in the market. It said that in 6 weeks, JP Morgan added 21 million ounces while closing a 200 million ounce paper short position. So by removing that paper short, they remove the pressure that keeps the price down. And while buying the physical metal, well, this is going to push prices up much higher. They also mentioned that they took 16.6 million ounces out of the registered inventory, and it left COMEX completely gone. We don't know where it went. And when 16 million ounces leaves COMEX, it ain't coming back ever. That would be my guess, in industrial. Silver is what's called a Giffen good. What Giffen good means is the higher the price goes, the greater the demand. Most assets don't work that way. They say the cure for high prices are higher prices. They also talked about the fact that they moved somewhere in the neighborhood of like 166 million ounces of silver. They moved it, 169 million ounces of silver, and they moved it into what's called a non-deliverable vault. Now, this was something that was new to me. I dig in a little bit. because I thought either it is or it isn't in the COMEX ecosystem. And it technically, these 169 million ounces, technically they still exist on paper and could be moved into COMEX, but it's legally removed from the delivery system, and it cannot be used for COMEX settlement unless it is re-registered. So, not only have they accumulated 750 million ounces of silver, and they have forever always been the biggest short, but they've flipped from short to long. They added 21 million ounces while closing a 200 million ounce paper short, according to this article. And then at the same time, 16.6 million ounces left the registered category, left the building. Goodbye, silver. And 169 got moved into vaults outside the COMEX deliverable status. This is not defensive posturing at all. This is intentional removal of metal from the delivery pool. And if it is true, it marks a huge shift from suppressing silver with paper to accumulating physical metal. And you want to talk about bullish. At the same time, and you can stop me anytime here, COMEX deliveries have been unusually large all year, Kaiser. In November, which is typically not a delivery month, we had almost 17 million ounces of silver and about 1.5 million ounces of gold that were delivered.
If we were to go to 1,200, well, I'm going to have to use the log scale, I'm afraid. It's just too big a move. But let's just measure it from here. What percentage would you be going to 1,200 from here? Well, because we've gone log scale, it doesn't look like much, but you will be back at 1782%. It's almost as if we're back down at the $25 going to 333. That is 18.8 times. 18.8 times. Call it 20 for a rounding error. You could be 20x from your current levels of $64. Your current levels. Do you want to make 20x? What do you think that does to your miners? And it shouldn't be, do you want to make 20x? It should mean, if you don't make this 20x, you aren't going to afford living.
This report breaks down one of the most significant structural shifts ever seen in the silver market, centered on the world's largest silver trust and the quiet but aggressive actions of major financial institutions. What many investors believe to be simple price-tracking instruments are, in reality, vehicles that can be closed, settled, and liquidated entirely within the rules of their own prospectus. That reality becomes critical when massive physical stockpiles are involved. According to recent reporting, JP Morgan is alleged to control more than 750 million ounces of physical silver, worth over $40 billion, making it potentially the largest silver holder on the planet. Even more striking is the claim that the bank has flipped from being the largest paper short to one of the largest longs, closing a 200 million ounce short position while simultaneously adding tens of millions of ounces of physical metal. This shift removes artificial downward pressure and replaces it with sustained upward momentum. The data becomes even more compelling when registered silver leaves COMEX and is moved into non-deliverable vaults, legally exiting the settlement system. Once silver leaves registered inventory, history suggests it does not return. Combined with unusually large COMEX deliveries and silver's unique status as a Giffen good, wear higher. Prices create more demand. The setup points to an explosive repricing scenario. A move toward $200 silver implies nearly a 20x return from current levels, with dramatic consequences for miners, markets, and living costs worldwide. Now let's get into the interview.
It's called fiat and debt debasement. It's called commodity. We'll eventually roll into a larger commodity inflationary bias, but the best place to remain is gold and silver because it will continue to outperform. And let's just remind people what it's outperforming, because it'll take a while before this guy turns around. It will really be very bad before this guy turns around. That's your oil chart, friends. $84 we said short, it's now 56. It's $56. And people were telling us, oh, you're going to be caught out on that one. Well, we weren't caught out. The gold ratio and the silver rate. Look at it's an absolute stagnating economy, and they want inflation to be masked. What do you think the Rockefeller tax merchants are doing to hide their most obvious trick? They are going to run and take less profits on their oil. They're going to oversupply it. And the demand is down. You're not buying as much on Amazon. You're not getting parcels delivered. Less packaging, less this, less that. Oil down, 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 down. That's your oil chart, friends. That's your oil chart. It's going to be one of the worst of the commodities, but eventually, such will the debasement be. It will eventually start to going up, but that is going to come a lot later. How many times, even Rick Rule, you should be buying Exxon and Mobil. No, you should be buying silver miners. It's an entire epoch. It's bigger than I thought he realized the scale. This is so big. This is quadrillions and trillions of debt that all have to get debased to nothing. And where is all that flow going? In the absence of a reserve asset, it goes to the only other remaining reserve asset, monetary metal, gold, silver, and platinum, to be followed up with it. Not a monetary metal, but a new, very rare, unique properties metal. So that is where you want to play. Don't leave. You're in the best place. And you should be maximizing. You should be taking 6-digit sums out of Mr. Slammy Day, as I've illustrated.
What this all ultimately points to is a long-term regime change, driven by fiat debasement, debt saturation, and the quiet destruction of purchasing power across the global economy. While many commodities will experience temporary booms and busts, the evidence increasingly shows that gold and silver are positioned to outperform everything else as the system deteriorates. Energy prices collapsing in a weakening demand environment are not a sign of strength. They are a signal of economic stagnation being deliberately masked. Oversupply, shrinking consumption, and falling industrial activity confirm that reality. As debt expands into the trillions and quadrillions, capital has fewer places to hide. In the absence of a credible reserve asset, flows naturally migrate toward monetary metals that cannot be printed, diluted, or politically engineered. This is not a short-term trade or a cyclical call. It is an entire epochal shift in how wealth is preserved. The opportunity is not in chasing lagging assets or listening to outdated playbooks, but in positioning where the structural flows are going next. If you're still here, you're already ahead of the crowd. This is about preparation, not prediction. And those who maximize their exposure early will not need permission later. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.